portfolio that both cash flows and appreciates. And so there are other ways that you can participate in investing in real estate, but it doesn't necessarily fit that criteria. But I kind of want to highlight to you how you can get started. I want to use myself as an example and kind of tell you a little bit about our story, and then how you can kind of at least introduce these concepts on how you can get started in this journey on how you can build your wealth and earn passive income. So first of all, the legalities. I'm not a financial advisor, accountant, tax lawyer, finance professional, and I also include counselor, psychologist, or therapist, although, being an oral medicinist, in many ways, I think I kind of act like a psychologist and therapist in many ways. But, these are my opinions and insights, and I'm just sharing you with what I learned, and I'm hoping that I can instill some wisdom and open your eyes about how you view things. However, it does not constitute professional advice. And so this information is for education and entertainment purposes only. So that's the legal portion of the talk. So I kind of wanted to start by telling you a little bit about my own story. So I started and it really begins as, this is a picture of the University of Toronto campus, right in downtown Toronto. So I was there, good 25, 28 years ago. So I'm kind of dating myself. But I remember, I think I always wanted to be a doctor of some kind. Actually, my first ambition was to be a physician. And, for some reason, I didn't get into medical school. And I thought, what's the next best thing? Well, being a dentist. You're called a doctor, you earn a good living. That's all I knew. I knew absolutely nothing about being a dentist other than going to spend some time with my own dentist that I had growing up since I was 5 years old. He looked like a happy guy. He looked pretty successful. Probably looked like he was, living a good life. But other than that, I knew absolutely nothing about dentistry. And so I kind of went into it. I got in. I was really happy that I got in. I thought, maybe I'm going to make a good living one day. But I absolutely had no idea what it entailed. So I remember just being there late night, in the labs, and this is an actual picture of us in the lab. I think I was pouring up some models and setting teeth for a denture setup. I know our prosthodontic faculty member in the back there is with us. And, but, I remember the whole time I was there, I kind of had this sinking feeling that, this isn't for me. I had no idea what I signed up for. So, you just kind of grind it out and you try to get your requirements and, barely pass, make it through, and you graduate. And I remember I was just so happy that I graduated. I said, okay, what next? Maybe I'll learn to like it. Maybe I'm going to earn a lot of money doing this. And so fortunately, I stumbled upon a career in oral medicine, and it's a wonderful career for me because it pretty much was the closest thing in dentistry to medicine, which was my original aspirational goals. And not only that, I just couldn't picture myself going to the same practice, the same four walls, working with the same 5 people and doing the same thing every single day. So I've been very fortunate to have a career, training residents, being in the hospital, dealing with challenging cases every day, doing research, publishing, and doing studies and NIH-funded research projects, and collaborating with people all around the world. So it's been a very fulfilling career on that front. And at the same time, while building my career, I had a family with 3 kids. And this picture is a little bit older now, but I still love this picture because it was taken at a nearby pumpkin patch that no longer exists now. It's been developed and turned into a hospital that we used to go to. You're raising a family. And, with raising a family, there are obligations and goals that you need to meet that you realize that you didn't realize that you had. You kind of intellectually knew you had it, but you didn't realize that you had them before you started earning money. So I told you that I really love my career, but there's one thing, and this is the story that I tell folks. You may love something. You may have your favorite food in the whole wide world. And let's say your favorite food in this case, pardon if I offend any of the vegetarians here in the group or the pescatarians, but let's say your favorite food was prime rib. But let's say that you are forced to eat prime rib 3 meals a day, every single day for the next 30 years. Well, that gets old. And you know, and let's say that you're forced to eat that. That's all you're forced to do. Yeah, sure, it's your favorite food, but you have to do it. You're doing it not because you want to, you're doing it because you have to. And what all of a sudden we're kind of, you know, it's kind of like the ball and chain. You know, I have to make a living. My job, even though I love it, I have to be there every single day. And, you know, and there's certain parameters that I have to do to be there every single day. And I can't just do it whenever I want to. I can't do it whenever I feel like it. You're obligated. You have to be there because I got that family of 5 that I have to support. Here's the other thing, at least my personal journey. Going into oral medicine, it's not as lucrative as some of the other specialties, or it's not even as lucrative as going into general dentistry. You know, I took an academic job. I took a job in a corporate academic medical center. There's not very many opportunities in oral medicine, at least good paying opportunities. So we had to uproot and move our family. This is my family back home in Canada. And this is Winnie's family back home in Canada. And, you know, we love living here in Charlotte. I have had the pleasure of training many of you folks, but I don't get to spend as much time with our family back home in Canada as I want to. You know, maybe if I'm lucky, we get to see them maybe 2 or 3 times a year. But, you know, it's just, there's a lot of family gatherings. There's, you know, my parents aren't getting any younger. There's just a lot of quality time that we miss that I've sacrificed in order to engage in this career, you know, down here. That has been fulfilling, but it's come at a personal price for me. So for me, that's my big why, is what can I do? What can I do to be able to spend more time with my family? Time. Time is more valuable than money. You can get more money, but you can't get more time. You can earn money. You can find ways to get money to grow. But once that time, that's our most precious asset. And once it's gone, it's gone. So some of you who have been on my lecture series on personal finance, I go through the math. What is the value of your time working as a dentist? So you take the average salary of a dentist and subtract for taxes at that tax bracket, you know, the 25%, 33% tax bracket. And I calculated what your take-home pay is based on the 2019 American Dental Association survey on dental salaries. And so after tax, the average general dentist after tax takes home about $10,000 monthly. So let's assume that they work 4 days a week, 10 hours a day, and 160 hours a month. That works out to about $63 per hour, or roughly about $1 per minute. So that's the value of your time. Now, you have to physically be there at work, cutting crowns, pulling teeth, whatever, to earn that $1 a minute. What about a specialist? And so I'll use the specialist like an oral and maxillofacial surgeon. I know we got a couple orthodontists in the house. I know the pediatric dentists do well. So, you know, they make a considerable more than the average general dentist. So it works out to about $23,000 monthly. Now I'm going to use an oral maxillofacial surgeon as an example. So let's say that they work a little bit harder, 5 days a week, 10 hours a day. So it works out to about 200 hours a month. So it roughly works out to about $115 an hour, or $2 a minute. So, you know, perhaps it does pay to do those extra 4 to 6 years of specialty, but you're taking home double the amount of what a general dentist does. But nevertheless, you know, you have to go in, you got to be pulling teeth, you got to be doing orthodontic surgeries, you got to be, you know, doing third molars in order to earn that $2 a minute take home after taxes. So let me take you back. You know, I talked about my days in University of Toronto as an undergrad, and I remember going to a bachelor party for my roommate, my roommate's brother, who was in dental school at the time, and I was an undergrad. And I just remember going in there and looking at all these dental students and thinking, man, these guys, they're going to be making big bucks. And so you get into dental school and you're thinking, yeah, I'm going to be making 6 figures. So you go to dental school, you grind it out, you barely make it through, at least in my case. Some of you probably thrived and were in the top of your class. And then you graduate, and it's probably like the happiest feeling in the world. And you're thinking, okay, you know, now this can all pay off. Let's start to get a return on my investment of my time and in my tuition. And so a lot of you go out in there and you go and associate, and a number of you go ahead and buy, eventually buy a practice, or have an ownership in a practice. And so, and all of a sudden, you're going from being a poor student, paying tens of thousands of dollars a year on credit, to getting this, whatever, $10,000 a month, $20,000 a month. So what's the first thing you do? He's like, well, I got to reward myself. And a number of you have seen these slides, but I'm reviewing it again because this is the typical cycle that most high earners go through. So first thing you do, well, I got to get a nice car. $400, $500 a month, I can hack that. So I'm going to get a BMW. Now, I never earned as much as my colleagues did. They were driving BMWs. I was driving a Toyota for many years. You start to go out, you have nice meals, you start traveling, you're thinking, oh, I've been deferring all of this. I'm making good money. Let me go take that trip to Europe that I've been putting off for a long time that I never got to do. Now I can afford it. I've got enough income to make this. And then, what's the first thing that everybody wants to do? The American dream. You feel like you're throwing money down the drain by paying rent. So why don't I own a house? So they'll get their starter home. That's the very first thing that you want to do. Yeah, and then all of a sudden, you get married, you start having kids. All of a sudden, you realize that starter home that you have isn't big enough. So you need a bigger home. And it's like, well, I'm earning good money, so I can afford the mortgage payments. So let's do that. Well, that little car that you had, you can't, you gotta be able to fit your entire family in it. So here's $100,000 Cadillac Escalade. I hate driving minivans. It's just so nerdy. I can afford it. Let me go ahead and get this. This Escalade. Or Mercedes GL. I had one of these, by the way. So, and I can afford it. Let's put our kids in the best schools so that eventually they're gonna, let's go for private school. I'm earning enough, I can do it. And then let's take trips, let's make memories. And so let's go travel. We've earned it. We're working our butts off. I'm making enough, I can pay for this. Well, this goes at a price also. So dental school, the average dental school student debt upon graduation is around $300,000. And so, it's roughly about $300,000, at least according to the 2019 survey. And so let's say with that average student debt, and if you were to quantify it in terms of making monthly payments for the next 25 years, it quantifies to about, for the general dentist, if you were to use that dollar a minute or that $63 an hour, it actually works out to about 38.5 hours of work a month. So that's a good, almost a week of going to work a month, a quarter of your work time, just paying off your student loans. Now, if you're an oral maxillofacial surgeon or an orthodontist, it's considerably less, but that's still a good chunk. It's about, I don't know, 3 days of work. Now, if you were to extrapolate this into, and again, if all you did was work, the average work week, and all of your money went to paying down your student loans, the average dentist is going to spend, now this is assuming that they pay it off in full. This is not if they get loan forgiveness or anything like that. They're going to devote almost 5 working years of work just to pay your student loans. So you got 5 years of going, this is not even feeding yourself. This is not doing anything else. An oral surgeon, maybe about 3 years. So what about the dream house? Well, we think about it in terms of like, well, I can make these monthly mortgage payments, so Marvin, North Carolina is literally around the corner from where I'm sitting. I don't live in Marvin. Marvin's got the highest median income in North Carolina. And there's a lot of physicians and dentists that live there. And so the average home in Marvin, North Carolina is $943,000. So let's assume that you buy a house there and you put 25% down. And so you're going to make about $3,251 mortgage payments per month at the interest rates at the current interest rate. So actually, you know what? I did this a few months ago. Interest rates have since gone higher, so your mortgage payments are probably a little bit higher than that. But let's go based on this. So a dentist, this totals to about 50 working hours per month. It's another quarter of your week. And then if you were to go through the life of the mortgage, it's 18,732 hours, or which works out to about 9.75 working years. So if all you did was work for 10 years and all of your money goes to paying down your mortgage, then you'll pay for your house. For a specialist, it works out to about 3 days working hours per month, 3 days per month, or 6 working years. So considerably less than the general dentist. So I talk about this, the high income earners losing loop. And so the general cycle of a dentist is that their income goes up, or any high income professional. And so the first thing they do is that they increase their expenses, whether it's car payments, whether it's the mortgage on their house, the student loans you have to do, you have to pay that. And then, when they get a house, they take out a big loan, and that becomes a liability. And then that liability, in order to service it, it becomes an expense. Mortgage, your car payments, the loan on your boat, whatever. And then what other people will do is like, well, the value of my house went up, so let me refinance it or get a home equity line of credit, and let's renovate the house or build a pool. So you're using a liability to fund another liability, which increases the expense in order to fund that liability. And so this is what we call the high income earners losing loop. And then, I use this example again, what if there's a disruption in your income, like when the pandemic hit and you're forced to shut down your practice, these expenses are still going on, but you can't go into the office and work. And therefore that source of income is gone. And that's a disaster. And I had a video here, but let me show you here. So this is really what we are. If you're in a job if you're in a career, even if you own your practice, if your income is totally correlated to the amount of time and effort that you put into work. This is the analogy that I like to use. Lucille Ball working in the chocolate factory and they can't keep up. You're a cog in the wheel. You are no different than the person that's in the assembly line, because all of your outputs, your income, is dependent on how much you are there at work. And what's that at the expense of? Your time. And so you have to. So what happens is and I'm talking to colleagues. They're forced to spend extra hours, long hours in their practice, and that brings you up towards burnout or health issues. But you've already committed yourself to all of these expenses, and what we call that you have to earn at this level, and that's what we call the golden handcuffs. There is just absolutely no way out. That for the next 20 or 30 years, you're stuck having to do this. So we just talked about maintaining your lifestyle. What about retiring? How much do you need to retire? And so, historically, when we looked at portfolios, over the last, that looks like almost 100 years, the returns of 100% bonds, is 6.1%, and 100% stocks is 10%. But you're never going to put your portfolio into either one of those things. So what we've been told is to go put a portfolio of 60% stocks, 40% bonds. And so, it's given maybe an average annual return of 9.1%. Now, the average investor doesn't even necessarily even do that well, because they have a portion in cash and they have a portion in other things. And I'm going to show you a little bit later that even though this is over the last 100 years, that those were the average annual returns, we really can't expect to get those returns in the future. So traditional financial planning, the financial planners that you work with, they'll say that, why don't you grow a portfolio big enough that it can cover your living expenses when you retire. And what they say is that, what's the ideal nest egg? Well, it's what they call the 4% rule. So the 4% rule is if you've saved up the equivalent of 25 times your living expenses, that's the target. So let's say that you're at age 35 now, and you've already accumulated $120,000 to date. And you get a pretty good 6% annual return on your investment. And now the last 20 years up until the last 2 years, inflation was sitting around like 2%. But if you were to actually look at the last 50 years, it was about 3.93%. Now, what was it the past year? They said that this year compared to last year, it's about 8%, which is, now, are we going to have 8% inflation every year? No, but I think we're certainly not going to be having 2% inflation in the future. So what I'm using in this model is, let's say, about close, just under 3.93% inflation. Now, how much money do you need to live? And so what they said is the average person, they estimate the monthly expenses in retirement is $4,100 to $8,100 monthly. So let's assume that, you don't have to pay for a mortgage on a house. But, you got living expenses. Now, this is the average person. This is not even the high income earner that lives, that's gotten accustomed to living a pretty cush life than the average worker. I would say it's probably closer to $10,000 monthly that you're going to need. Now, that's in today's dollars. What about after inflation? Well, let's see what you get when you have a certain nest egg. So let's say you have $1 million nest egg. And this is, again, what the traditional financial planners will do, is they'll say, okay, you need to get to about $2 million. And then hopefully you can withdraw 4%. And, there's a good chance that if you do that, you're not going to run out of money before you die. And so if you took out 4% of $1 million, in order to get $1 million, starting now, you have to contribute about $310 monthly. That's not bad. It will give you about a $3,300 monthly income. Now, what did we say that you need to live on? $4,100 to $8,100 monthly. So even in today's dollars, that's not going to cut it. What about after you adjust for inflation? Well, it's only really going to be worth about $1,150 monthly. That's the poverty line. So $1 million portfolio using the 4% rule is going to give you something that's well below the poverty line. You can't live off of that. What about a $2 million portfolio? Well, it should give you about $6,600 monthly income. Now you have to contribute $1,300 monthly to get there. Again, it's very achievable, assuming that you get a 6% annual return, which I think is pretty optimistic. But then you'll also get $2,300 inflation adjusted at age 65. This is, again, still around the poverty line. Your $6,600 is only going to be worth $2,300 a monthly. And we said the minimum is about $4,100 to live for an average person, not even for a high income earner. $3 million, you get $10,000 monthly income. It translates to about $3,500 inflation adjusted. Now, can you live off of $3,500? I don't know. $4 million, you're going to have to contribute $3,295 monthly. And that will give you a $13,000 monthly income. And it will give you about $4,700 after inflation adjusted income when you're 65. So that just gets us over that minimum threshold. And that's the minimum threshold for an average person, assuming you're going to get a 6% annual return and that inflation is going to be 3.93%. What was it again last year? 8%. So the typical financial planner will say, okay, why don't you build up a nest egg of whatever, $2, $3, $4 million? And then they'll run these things called these Monte Carlo analysis simulation. And then they'll kind of show you these lines and saying, okay, well, if things go well, you'll probably be here. If things don't go well, you'll probably be over here. And so hopefully you don't run out of money before you die. So you build up a big nest egg and then you hope you don't deplete it all the way down. Now, Morningstar suggests that the 4% rule no longer applies. Morningstar is a very good source for investing. And the reason why they say that is because we don't expect stocks to give the same returns that they've given in the last 20 years. Because a lot of these assumptions with the 4% rule was based on historical returns over the last 20, 25 years. Stocks right now are at an all-time high valuation. Now, I know we've had a bit of a correction lately because interest rates went up. Well, why are stocks valuated so high? It's because we've had record low interest rates. So any slight increase in interest rate would actually significantly decrease the value of stocks. And even though we've had an increase in interest rates, we're still at historical lows. Bonds. we have record low interest rates for bonds. Well, bonds will pay, they're supposed to be there to give you income. Well, the income is directly correlated to what the interest rates are at the time. And if the interest rates are really low, bonds are not going to be paying you very much income at all. In addition to that, bonds are valued based on the interest rate at the time that you bought it. So let's say you bought a bond and the interest rate at the time was, it pays 8%. Well, if interest rates go low, if they decrease, the value of that bond itself actually goes up because you cannot buy a bond that pays that much. Well, the thing is now, if you buy a bond now at record low interest rates, there's nowhere to go where interest rates to go but up, which would then send the value of bonds down. So not only do you have a bond that pays you very little, it's also got nowhere to go in valuation but down. And if you're lucky, it's going to stay flat. So because of that, it is unlikely that returns will be the same as previous years. So Morningstar recommends a 3.3% withdrawal rate in retirement. Now, Vanguard, one of the largest mutual fund companies in the world, what do they forecast the 10-year returns, the stock market? Now, we said that historical in the last 100 years, it was about 10%. They forecast US growth stocks to give you a almost 0% return in the next 10 years because of these record high valuations. And then they also say that US value stocks, these are the ones that are the more established companies, to only give you about a 4% return. So remember these projections that I made in the previous slide. It was based on a 6% return, which I think was optimistic. I think you are really too optimistic if you're thinking that you're going to get the same return, the 10%, 9% return on your investment by putting your money in the stock market or in a portfolio of stocks and bonds. So let's apply this 3.3% rule. So let's say you're just starting out, you're a 27-year-old dentist, and the average inflation rate over the last 50 years was 3.93%. And so let's say that you want to have an income of $100,000 or whatever the equivalent of $100,000 is in today's dollars. And so by 2060, the time that you would retire, you would need to get $432,000. You would need to have that amount. So let's divide that point by 3.3%. You're going to need a staggering $13 million portfolio when you retire in order to get income that's just going to pay you the equivalent of $100,000. So now let's assume that there's a 5% annual return in a portfolio of stocks and bonds. You're going to have to allocate $120,000 annually for the next 38 years. And now I say, what's the value of your time? That translates to 166 working hours per month. That's the equivalent of pretty much your entire take-home pay if you're a general dentist. It's just not achievable. So let's kind of take all of this and show you where your monthly work hours go. And this is why I tell you that a lot of the traditional planning isn't going to work. You got your student loans. You got to devote 38.5 hours of your week. You got your dream home, and you got to devote 50 hours a week. This is just to pay the mortgage. This is not even to pay the utility bills. This is not even to pay the insurance. This is not even to pay the property tax. This is just to pay the mortgage. And then retirement savings, just to get that modest $100,000 of income, when you retire, you got to devote 166 hours. So you haven't even fed yourself yet. You haven't even done anything else. You haven't even paid for your kids' school. You haven't paid for your medical bills. You got to work 200, and this is a general dentist, by the way, on the $1 a minute rule. You got to work 255 hours a month. That's 60 hours a month just to cover these things if you think you want to hit those targets. So it's just not going to cut it. So the only way is maybe you got to be this guy. Maybe you got to work till you're 100. This dentist, age 97, at least as of 2007, he was working all the way up till he was 97. Well, let's kind of back up there. Now I'm kind of giving you a pretty pessimistic model, but the math doesn't lie. And so, I think I think the issue is that I think we're going to be in a situation where we're going to have individuals that are underfunded when they retire, and they're in a situation either where they have to downgrade their lifestyle significantly, or they're going to run out of money before they die. And so let's go back to the present. Either you got to sit there, your work, your hours at work is devoted directly, is going to directly correlate to how much income you make, and you're just not going to be there to attend your children's dance recitals, soccer practice, all of these things, let alone think about retiring, if you don't think another way. All right. I'm going to kind of skip this film just because for the sake of time, and I'm not sure if the sound works. So let's shift gears and talk about change in mindset, change in models. If anybody has read the book Rich Dad, Poor Dad by Robert Kiyosaki, he goes through what we call the cash flow quadrant. And you got the E, the B, the S, and the I. And so I'm an E. I'm an employee of a academic corporate medical center. You have a job. You're taxed considerably. Pretty much a good chunk of my paycheck is already deducted before it even hits my bank account because I got to pay Uncle Sam. So basically my income is directly correlated to my hours of work. A number of you out here, whether you're an associate for a dental practice, you're an E. Now we're just thinking, well, what if I own my own practice? Well, you're an S. Those S's are actually taxed at a higher rate than the E's because your business is taxed and then your income as an individual is taxed. Now, I know there are some tax breaks and things like that, but on the whole, they tend to be the tax the most. And so you're owning your practice. You're self-employed. That's most dentists out there that own their practice. And so you own a job, so the only difference is that you're your own boss. And so, but nevertheless, you got to go in there and you got to cut your crowns. You got to put in your braces. You got to take out your wisdom teeth. And if you don't get paid. You own a job. What about a business owner? Now, I know a number of you, have gone out there and you're aspiring and you're looking to start owning multiple practices that don't necessarily rely on you being there producing in order to make money. Great. So, and there's also more tax advantages in that. So that's being a business owner. You own a system. That's where the wealthy are. But the truly wealthy are the people that are I's. Those are investors. You're putting your money, you're risking your capital, but that's where you get the greatest returns. You also have the greatest tax breaks. When you have good tax breaks when you're on the right side of the quadrant, the B's and the I's. You got the greatest tax breaks when you're an investor. Now, why? Because the government wants to incentivize people to risk their hard-earned money, their capital, to help fund these businesses or fund housing for people. You're taking on risk, and so they reward you in order to do that in the form of the tax code. So the goal is, instead of just sitting there chairside and grinding it out for 40, 60 hours a week as your sole source of income, you want to kind of build your portfolio of assets. Now, I use this graphic. This was I actually took a screenshot of our own net worth. I'm not going to show you what exactly it is, but I just use that as an example. But you want to build your assets so that these assets in themselves pay you money. They generate cash flow. They appreciate and they generate cash flow so that you can replace your income. And so all of you are here because you wanted to hear about how real estate can do that. And it can start small. You can start by making a small investment, buying a single property, and you can grow it. There are ways you can grow it where you can grow your portfolio of assets such that all of a sudden, instead of buying that house, we're using Monopoly, you're buying the hotel, you're adding multiple houses. And, what happens when you do that? Well, the valuation of your property goes up. Monopoly is a very good analogy of how you can, you can grow your assets, increase your income. What happens when you have more houses on Boardwalk? Somebody lands there, they got to pay more. That increases your income. You want to keep doing that so that your income is not dependent on you physically being at work. So what do the ultra wealthy do? Well, the ultra wealthy, they have a portfolio. They have grown, they have accumulated their wealth, and they have preserved their wealth, not by putting their money, entrusting their money into strictly stocks, bonds, and mutual funds. They allocate, they still do have some in stocks and bonds. So 29% in stocks, that's what equities are. Fixed income is about 15%. So those are your bonds. And then, but they have 50% of their net worth in alternatives. So what are the alternatives? Real estate, commodities, their business, collectibles, other things. And then the other thing is that they usually keep some cash on hand because they could, but they're also ready to cash in whenever there are things that happen, like recessions. You know, when recessions happen, asset prices go down. That's when they go in. It's like going in. It's like Black Friday. You know, whereas everybody gets scared and sells everything. You know, the rich people and the smart people, they'll use that cash they've saved up and buy assets at pennies on the dollar. So let's talk about real estate and how it's built fortunes. So Charlie Munger is Warren Buffett's billionaire partner for Berkshire Hathaway. Well, you know, we know Berkshire Hathaway for owning companies and buying stocks, but Charlie Munger initially built his wealth. He was first a lawyer for a real estate firm, and then he decided, why would I be a lawyer for a real estate firm when I can actually be the real estate investor? So he started as a developer in California. And so his 2 real estate projects in Pasadena quadrupled his money. That's what got him started. That's what initially built him his wealth. Shaquille O'Neal was actually a speaker at a real estate conference here in Charlotte in the summer. I mean, he's a very, very smart investor, very, very smart entrepreneur. And, you know, to be honest, I think his father instilled this at him at an early age, early in his NBA career. He was already investing in, you know, he was flipping houses at age 26 while he was just getting started as an NBA player. He had developed a $65 million affordable housing project in Denver. He's got a project, 1,000-unit project in Miami, and an $80 million apartment complex in New Jersey. Emmett Smith, this is a screenshot from Newmark. Newmark is actually one of the large real estate brokerage firms. He's actually a broker. He's the licensed real estate broker. And so he's listed as one of their brokers. Emmett Smith, one of the greatest running backs of all time. So not only is he a real estate broker, but he's a real estate investor. He's a prolific real estate investor. So he has taken what he's earned in his day job and has grown his wealth by doing that. He didn't spend it or blow it all away like a lot of athletes do. He's growing it. He's investing it. Arnold Schwarzenegger, when he was a bodybuilder in the 70s, a lot of his bodybuilder counterparts they were struggling to make ends meet. And he decided that he wasn't going to be one of those folks. So in the 70s, when there was a recession and when inflation was at rampant levels in the late 70s, what did he do? He bought apartment buildings in LA before any of us knew who he was. And so he was actually a financially free real estate investor before he even was a movie star, before he even was on Conan the Barbarian. He was already financially free as a real estate investor. So why is real estate a great asset to invest in? Number one, if you do it right, it brings in cash flow. You don't buy, now most people buy real estate for appreciation. That's the wrong way to go about it. If that's all you're going to do, you buy real estate to generate cash flow. You want money to come to you after all of your expenses. So we know that. Appreciation. That's the number one reason why, you know, people are like, oh, this neighborhood's really hot. I'm going to buy a house here. It's going to be worth more later on. That's gambling, but that's a great benefit of investing in real estate. Now, the nice thing is there are ways that you can actually force appreciation in real estate. Depreciation. Now, real estate, you know, it has things that breaks down. And if it's an investment, you can do what they call a cost segregation analysis. And they can actually value the assets inside your property that are going to depreciate. And they can actually give you a value of that. And you can actually write it as a tax write-off. And so that's the reason why a lot of the cash flow in real estate is tax-free. And then, you know, if you're an active investor like we are, you're actually able to use this depreciation value of your property to offset against all of your other active income. And you get a nice big tax break. It's an incentive in order for you to invest in real estate. And the last thing is you build equity when you pay down debt. If you got tenants, your tenants it's not you that's paying down the debt, it's your tenants that are paying down the debt. And as the debt gets paid down for free, well, you know, you're actually building more equity into the property. Now, I'm going to talk specifically about multifamily housing. Now, why is housing a good asset to invest in? Well, right now we are in a significant housing shortage, especially with with the millennial generation, going into their which is the largest population right now. You're going into your prime earning years, and so there's just such a great demand, but there's a lack of supply. Whenever there's a great demand and lack of supply, that drives prices up. And so there's a shortage of houses that drives mortgage payments out. There's a great divide. There's a great delta between mortgage payments and apartment rent. And so more people, because of that difference, more people are going to be pushed into renting. So that actually works favorably if you are a landlord. Housing is a basic need. People need a place to live. So fewer households can afford to own homes. And so what we're finding is that the minimum annual income has skyrocketed in 2022 in order to afford a home, and so that pushes more individuals into renting. That means that so the demand is there. We're not looking at a situation like 2008. What's another reason why we're not looking at a situation like 2008? Well, 2008, in the time leading up to 2008, we didn't have that big spike of millennials that were buying houses. They were in elementary school at the time, or high school, or what, and there was an oversupply of houses. And so what happened was, you had an oversupply of houses. And then of course the predatory lending practices of the banks, and then all of a sudden people can't afford their mortgages. All of a sudden that even increased the supply more because people were selling their houses or they were just getting foreclosed on. And so when there's a high supply, the values go down, and this is what happened. Now, if you bought it this time, you've done really well. What about now? There's still an undersupply of houses, and yet which is reflecting in housing price changes. Again, good as an investor for the potential valuation of a home. A little bit hard to find deals, but potentially long term, it's good for an investor. It also then again pushes more people from buying to renting. The demand is there. So what are the different ways that you can invest in real estate? And I'm going to talk about investing. I'm not talking about flipping. Flipping is not investing. Flipping is actually another job. Now, you can make a lot of money flipping. That's not investing. You're not putting your money in and letting it earn money for you. When you're flipping, you're buying a house, you're fixing it, and then you're selling it, you're turning it around and selling it, and then you're doing it again and again and again. So I'm talking about investing, where you're buying something either directly or indirectly, and then you're collecting income. So direct ownership is the one that we know about. So people buy second homes, or they buy apartment buildings, or they buy short-term rentals. I'll go briefly into all those different ways. But there's always headaches with that. There's a lot of costs involved with that. It's not passive. You actually have to put in your own money for it. You actually got to manage it. We see on HGTV, they're going in there and they're fixing it. If you got tenants, you got to deal with, what are they, you're always concerned about the 2 o'clock in the middle of the night phone call for toilets, the leaky toilet. And so if you don't want to be a direct owner, then you can go into passive ownership. And so I'll go over briefly all the different types of passive ownership: turnkey ownership, syndications, real estate funds, and crowdfunding. And then, one other way that you can invest in real estate, although I consider this more like investing in the stock market, is investing in real estate investment trusts. So direct ownership. So this is one of the first properties that we bought in Florida in 2020, right at the height of the pandemic. So we bought this. It's a quadplex. It's actually a home in the front in an historic area in Tampa, and then a triplex behind it. And we put in quite a bit of money to buy it. We put in quite a bit of money to renovate it. And so these are the immediate post renovation photos. So took a lot of work. Interestingly enough, we were able to do it remotely. We didn't even see this property physically until after it was renovated and 1 year later. Now that's a different story, about how we were able to do that. Here's an example: short-term rentals. Short-term rentals, you buy a house, you furnish it, you make it really nice. You can charge, a significant amount, even if the occupancy is only, 30, 40, 50%. You can get pretty high returns on these. Some people are getting about 30% cash on cash return. Cash on cash is how much money did you put in, and how much is your annual return based on the amount of money that you put in. And so some people are getting really high returns on a short-term rental. I had a cousin that their first short-term rental in West Virginia, they were able to generate about, they're projecting that they're going to generate about $100,000 in revenue. Now this is pre-expenses, but just from that one house. And then, you can buy apartment buildings. You can either do it yourself if you've grown your portfolio, or you can partner up with somebody else to directly buy and own an apartment building. Turnkey ownership. Now that we're going into the more passive ways of owning real estate. And so what they do is you have these companies that they've already bought properties, they've renovated it, they've got it in rent-ready condition. So all you have to do is buy it from them, and they will manage it. They will even sell it for you if you ever come. They will, if you ever comes time. So it's considerably, it's passive. But the cost of entry is still pretty high. It's like buying a property yourself, and so you got to put 25% down. The repair costs are low because generally they've already done most of the repairs on the front end for you. Again, like I said, it's more investment up front because it is fixed. They generally have to pay more for it. The other thing is that you don't really build much equity beyond the down payment. Now, what is the trick for individuals that buy a house, renovate it? They're increasing the value of the house. They're increasing the equity on the house. And that's why they're able to turn it around and flip it and make a profit on it, because they've increased their equity. Well, if you get turnkey ownership, you're not really increasing the equity. You're not forcing the value other than just the market appreciation. So you don't have much, you're not really gaining much that way. And then of course you got to pay the third party operator, which is, because it's passive, your returns are going to be less because more of it's going to go to fees to the operator. What about syndications? So what we have, syndications is basically you have a group of individuals pooling their money together to buy a large property. And so, pictured on the right are actually 3 properties that we are passive investors in. And so one is in an apartment complex in Atlanta, one is a development in Durham, North Carolina, and the one on the bottom is an apartment complex across from the Houston Texans football stadium in Houston, Texas. And so what you're doing is, if you're a passive investor or a what they call a limited partner, you get a share in the profits. All you have to do is evaluate the opportunity, put your money in, and just collect the mailbox money. And so you share in the profits based on the cash flow and also the proceeds on sale. Usually these properties you want to hold for about 3 to 7 years, and then you sell it. And then, usually what happens is they renovate the properties, they force appreciation on it. And then when it comes time to sell it, you sell it for a profit, and then the limited partners get a share of that. And the other thing is that it's generally tax-free income. So you participate in these paper losses that I talked about. So when a lot of times when you're investing in dividends and stocks, you get 8%, but then you got to pay taxes on your dividends. When you're investing in a real estate syndication and you get 8%, you're getting 8%. You're actually keeping 8%. Now, the downside is that the cost of entry is usually a little bit higher. So it's usually about $25,000 to $100,000 minimum, or if it's a real established deal sponsor, it can be up to $200,000. However, the returns are pretty significant. You can expect about 12 to 25% annual rate of return compounding every year. And so generally, as a passive investor, you want to, you get about 6 to 10% cash on cash. So if you put 100,000, you would get anywhere from 6,000 to 10,000 a year. EM is called equity multiple. So what that means is if you get a 1.5 equity multiple, if you put 100,000, when you exit, get your money back, you should get 150,000. Or if it's a 2 times equity multiple, you should get 200,000. So it's like 100% total return if it's a 2x equity multiple. And then your average annual return, again, is about 12 to 25% average annual returns. This is much better than the 4% that Vanguard is projecting that the stock market's going to do in 10 years. Now, the drawback, again, is the high cost of entry. In a number of these deals, you got to be what they call an accredited investor or a sophisticated investor. Now, being a sophisticated investor is pretty easy to achieve. And it's illiquid. When you put the money in, it's locked in there. It's locked in there for 3 to 7 years. So once the partnership exits and sells the property, that's when you get your money back. Otherwise, if you need that money within the next 3 to 7 years, don't invest it. Real estate funds. Now, real estate funds are professionally managed funds that invest in real estate. They also usually are institutional funds. They're usually offered to endowment funds, pensions, high net worth individuals. And so, and what they do is they invest in a portfolio of properties. So, like Blackstone, for instance, is an owner of real estate, and they offer investments to institutional investors. So your pension funds, your universities, your endowments, things like that. They usually give similar returns, about 8 to 10%. Now, there's a number of real estate funds that are offered to high income earners, doctors, dentists, lawyers, physicians, and that sort of thing. But again, your money is illiquid, and usually the entry is usually a little bit higher. So it's usually more suitable for if you've accumulated some and you're further along in your career. Now, a good way to get in is something called crowdfunding. And so there's these sites on the internet, Fundrise, Yield Street. Now, I personally invested in Yield Street as one of my first passive investments. And the beauty of that is that you can actually put, again, it's just like syndication, real estate funds. Usually what it is, they'll have an offering and say, oh, we've got this apartment complex in Orlando, Florida, invest in this. And so all you do is you kind of put your money in. Usually the minimums are a little bit lower. They can be lower. Some of them have high minimums, but some sites will give a minimum of like $1,000 or $10,000. Now, the drawback here is that you don't get to participate in the tax advantages. So any income that you earn from the crowdfunding site is taxable. There are more fees for the platform and the asset manager now, in order to manage these funds. And the other thing is that a lot of these crowdfunding sites, they're rather new. So they don't really have, it's a new platform. They really don't have much of a track record in order, how have they done? Whereas like, more of the funds and the syndications, if you got somebody that's been doing it for 10 years, 15 years, you can kind of say, hey, how have you performed? What have you done in the past? You can't really do that when you're crowdfunding. The other thing is that with syndications, you can actually talk directly with the people that are running the fund, running the property. Whereas, in crowdfunding, you're kind of putting your money into this, and it's kind of a faceless person that you don't have contact with. But again, it was one of the very first things that I put my money in. I invested in an apartment building in Houston through Yield Street. It generated a return for about a year, and then got my money back. And it was kind of nice seeing all that money coming into my account on a monthly basis. Real estate investment trusts are publicly traded companies that hold real estate. They're pretty much just like stocks. So they fluctuate a lot. Well, they fluctuate a lot because they're liquid. Liquid meaning that I can open up my TD account, and if I don't want to hold it anymore, I can just press a button and sell it. And I can buy just as easily. And so that's liquid, as opposed to the other ones, you put your money, it's stuck in 3 to 7 years. And because for that reason, they're not volatile. You got to distribute. Now, the nice thing is REITs have to distribute 90% of their income to the investors as dividends. But again, the dividends are taxed at the rate that dividends get taxed. Yeah, they say it provides some diversity, but there is some fluctuation with the stock market. So I can tell you, like, the stock market as a whole went down. Well, so did my REITs. My REITs went down. I'm actually kind of underwater on several of my REITs that were well ahead, a couple of years, about a year ago, when everything was up. But, they have a track record that's comparable to stocks, about 10% average annual return. So I have talked about the different ways that you can invest in real estate. And so you can start with a lot of money, you can direct ownership, or you can do passive ownership with lesser money. And you can do something that's illiquid, and you can do something that's liquid. So how does this actually look like if you were to actually apply numbers to it? So here are some examples. So let's start with an example of direct ownership of a long-term rental. Long-term meaning, you have tenants that sign leases that are, 6 months to a year. And that's different than short-term rental, than your Airbnbs and your VRBO. So this is what I mean when I talk about long-term rental. So let's say that you got a $200,000 property. Now I know, dependent, most markets it's a little bit harder. Let's say that this is a duplex and you got it for 200,000. Now I'm just using 200,000 as a nice round number. So, some I think you're probably hard pressed to find a duplex in most markets for 200,000, although you might be able to still do so. But if you're thinking about a larger, another market, just multiply the numbers accordingly. So, but let's say it's 200,000 for a duplex. Most real estate loans, investor loans, you got to put 25% down, which is good. You don't want to be overly leveraged. So you have to put $50,000 down. Now let's assume that it was previously being rented out to tenants, but you feel like it's not quite up to market rent. And so you need to renovate it, make it nicer so that you can raise the rents. And so you were able to raise the rents by $200 a month, but you had to spend about $20,000 in renovation. So this sounds about typical and reasonable. Now, if you've done a long-term rental right, your target is to get what we call about a 10% cash on cash, meaning if you put $50,000 down and $20,000 in renovations, you should target getting 10%. So a year. So that 10% of 70,000 is 7,000. So let's say this is after expenses. So if you did this right, so let's say cash flows about $7,000 a year, you did it right. And you paid a little bit of the mortgage down in year one. $2,500 in the mortgage. Now, I know most of your mortgage payments goes down to interest and not principal, but let's say you made about $2,500 in principal payment. And then, historically, the market has appreciated 4%. It's not the 10, 20% that we've experienced in the last 2 years. Let's say that you just go through historical market appreciation of 4%. So it's appreciated an additional $8,000. And then by renovating it and increasing rents, you've actually increased the value of the property. And so you've forced $40,000 worth of appreciation in the property. So now after year one, it's not worth 200,000, it's worth 248,000. So what is your return on investment when you add all of this together? You've put $70,000 down. You have gained $57,500 in year one when you're factoring in cash flow, equity pay down, market appreciation, and forced appreciation. I didn't even factor in any tax savings that you would gain on this. So that's an 82% return on your investment in year one. What about year two? So let's say rents go up, a little bit. You raise the rent by another $100 the following year. So you have $7,100 of annual cash flow. It appreciated by 4%, $9,920. And then you've paid down another $2,500 of the mortgage. Actually, probably in year two, it's going to be a little bit more than year one, but just for the sake of simplicity, let's use that. So you've actually gained another $12,420 in equity, which is an additional 28% return on investment in year two, in addition to that 57, what did I say? It was 82% return on investment in year one. Year three, raise the rents a little bit again, $7,242 in cash flow. You get it appreciated another 4% from the previous year. You pay down your equity. You got an additional $12,800 in appreciation in equity, and so you're getting a 29% return on equity in year three, in addition to the 28% and the 82% in that you got in year one. That's return of your $70,000 initial investment. So in 3 years, $70,000 have yielded $21,000 in cash flow and $75,736 in equity for the, with the value of the property of being $268,236 that you, for a property that you bought for $200,000, and you've paid down some of that mortgage. So the total is $97,000, which is a 139% total return on your initial $70,000 investment on one single property. That gives you a 33% average annual return compounded. So that's one property. What if you decide you've built enough equity in this property? Why don't I pull out some cash on it? And so in year three, you've got about $142,500 in your mortgage, in your original mortgage. If you cash out refi, let's say again at 75% the new value, it's now you can pull out a $201,000 mortgage, which gives you, you're able to pull out roughly about $58,000. What do you do with that $58,000? Go ahead, go ahead and invest in another property. And let me go back to the other slides here. So your equity after the refi, you still got $67,000 of equity after refi. So roughly about what you put in initially, your 70,000, that you put in initially. So, if real estate prices go down a little bit, you're still not, you still got a bit of a buffer. You won't be underwater, and hopefully you're still going to be cash flowing. So like I said, you take that $58,000 and you purchase property number 2, another duplex. So let's say it's 60,000 down. So that 58,000 plus 2,000. Let's say you put another $20,000 in renovations. Now that 20,000, if you were wise, you actually saved all of the cash flow that you generated from property 1, which was 21,000. You can use that to put into your renovations for property number 2. You raise the rents again. You got $7,200 in cash flow annually. You're still paying down $2,500 in equity. It appreciates by $9,600. And then you force appreciation by doing the renovations, again, similar to property 1 of $40,000. So you've added another $52,100 in equity by making the second purchase. So what about year 4? So you've got $72,000 of total money in. You've gained $17,000 in equity of property 1 after the refi. Property 2, you've gained $52,000 of equity, both on forced appreciation, market appreciation, and debt paydown. Your total equity gain is about $69,159. That's a 96% total return on your investment just on appreciation and debt paydown alone. That gives you an 18% average annual return. That beats the 4% stock market return. And you are cash flowing property 1 annually on an annual basis in year 4. This doesn't even include the previous years. This is just that year. $7,300 in year 1, and then plus $8,700 in year 2, which gives you about $16,000 of cash flow on your original $72,000 investment. That's a 22% cash on cash. So great. So we've demonstrated the power of buying a couple properties. And what you do is you just keep doing that. And that's how people are able to expand their portfolio and build their wealth and build their cash flow by direct ownership of real estate. Now, what if you're just starting out? Let's say that you're a resident and you're early in your career and you don't have 50 grand to put down. So this is the beauty of being a dentist. We got access to doctor loans. And so where you can put 0 to 3% down. So let's say you got a $200,000 property. You put it, you get a 3% doctor loan for $6,000 down. You put 20,000 in renovations. You live in one unit and you rent out the other unit. And let's say that by you living in the one unit and renting out the other unit, you're living for free. You're not getting any cash flow, but you're still paying down equity free. It's still appreciating by 4%. And by renovating it, you forced appreciation by 40 grand. So your $26,000 in has given you $50,000 in equity, a 94% return on investment in year 1. Plus, you got to live in this place for free. That's an additional $25,000 savings. So that's really $75,000 gain when you think about it. Year 2, still live in unit 1, rent out unit 2. You're still not cash flowing, but it's still, you're still paying down the mortgage and it's still appreciating. So after year 2, you have pretty much gained $62,984 in equity from appreciation, forced and market appreciation, and debt paydown. That's 142% return on your $26,000 initial investment. And you got to live in it for free. Save that after year 2, that's $50,000 in savings. So you gained an additional $50,000 there. What about year 3? let's purchase the second property. So you cash out refi, you cash out refi property one, you actually will get money. So you're going from a doctor's loan at 97% to a conventional real estate loan at 75%. You actually still get $5,600 back that you can apply to your down payment for property two. Then is only about $1,600. When you add that $5,600, let's say you put $20,000 in renovations again, you live in one. And by the way, you can use these doctor's loans on, as long as you live in it for a period of time. So what's happening is that second property you're able to buy using a loan for a personal residence, because it is your personal residence. And that's why you're able to put less money down. So you live in unit one, rent out unit two. The cash flow in it, again, is zero. You live for free. You pay down $2,500 in equity. It appreciates 4%. And then you force depreciation through your renovations, another 40 grand. And so now you've got, $53,700 gives you 148% return on your investment, just on that appreciation. And again, you live for free. At the end of year three, you've got $7,000 of cash flow coming from property one. Now that you're no longer living in it, you've gained $59,000 in equity by only putting $26,000 into it. Your return on investment is 123%. And your cash on cash, if you were to average it out over the 3 years, it's only 6.7%, but it's low because you lived in it the first 2 years. So a 6.7% return averaged over the 3 years is still pretty darn good. And you saved $75,000 in rent and expenses in living in a house. Actually, $100,000 because it was the end of, it's the end of that year. So if you were to combine properties one and two, you got $7,000 in cash flow, you got $112,700 in equity gain from $47,600 of money that you put into both properties. So your return on investment is 136%. Your cash on cash, again, it's only 3.7%, but that's because you get to live for free and you've saved $100,000. So this is how you do it when you're starting off. So, instead of trying to get that initial house that, just to get that dream house, you can significantly accelerate your wealth by doing what we call house hacking at the beginning. I wish I did this at the beginning and knew what I knew back then. I'd be much wealthier now. Now, what if you don't want to own your own properties? What if you want to invest passively? So let's use the example of a real estate syndication. And so you just want to put your money in, you've accumulated some money mid-career, and you want it to grow for you. So let's say you've got, your mid-career, you got $100,000 to invest. And the typical syndication, I'm just going to use, typically about an 8% cash on cash. So meaning that you put in $100,000, you'll earn about $8,000 in income. So let's say that you've earned cash, it actually should be about $24,000 in cash. Well, and then you get $6,000 additional on sale. And then you get $100,000 return of principal. So you've doubled your money after the first investment. And so that should actually be year 5. So not year 3. So you've got $75,000 to invest plus 200,000, let's say you've accumulated an additional 75,000 over the 5 years. And then you've got another $200,000 to invest based on the amount that you've generated in cash flow from the first investment, plus plus your initial principal. And then you reinvest it again. So let's add, 2 years. That should actually be, let's say year 10. You've got $88,000 of total, or year 9, sorry. So that's 4 years of income. You got $88,000 of total cash. You have made $187,000 additional on sale of the property when you exit, and then you've got a $275,000 return of your original principal. So you've doubled your money. Your $275,000 has become $550,000. So let's say you've accumulated again another $100,000 plus that $550,000. And then let's assume that you're getting another 8% income annually. And so again, this should be about year 13 again. So the math is wrong, but let's say that's year 13. And you've accumulated about $52,000 in total cash, from that investment in those intervening years, plus another $598,000 on sale. Those are the profits. Those are your share of the profits on sale of the property once you've exited. Once the deal sponsor has exited and sold the property, and they return the profits to all of the investors. So you've got $650,000 total, plus an additional $650,000 return on principal. And so you originally invested $275,000, which has now become $1.3 million, assuming that you've reinvested all of the money that you earned in cash flow. This is entirely passive. This is without you having to deal with toilets, you having to deal with renovations, you having to go in and fix stuff. This is just you as a passive investor. Your $275,000 in 12 years has become $1.3 million. So that's a 372% total return, and it's roughly about a 15 to 16% average annual return. So let's say you take that $1.3 million and then you reinvest it again at 8% cash on cash. You will get about $104,000 annual cash flow. This is much more achievable than having to sock away $13 million at age 65 and hope that it's going to generate 100,000. Now I know, of course, there's going to be some, there's going to be some inflation after that, but this is a much easier way, to get to where you need, rather than having to accumulate a $13 million nest egg to get $100,000. So here's the ultimate goal. You want to accumulate assets that's going to replace your income in the form of rents, royalties, interest, dividends, or capital gains, big payoff. But you generally want you want to get things that are more in the top four. Things that you don't have to sell the asset, or you don't, in order to generate income. So let's circle back to our situation. So 3 years ago, around this time, I knew absolutely nothing about investing in real estate, other than, I invested in maybe one crowdfunding site and a few REITs. And we bought our first property in 2020. One of them is the one that's pictured above. So that property, we bought it for $330,000, this quadplex. Now we put about $150,000 in renovations into it. Now the rents, we've raised the rents immediately the rents now are about 33% higher than they were initially. So like that house that you're seeing on the upper left, before we bought the property, was renting at about $1,200 a month. Today, it's renting for about $2,600 a month. Those units in the back there in that triplex, I think they were renting for about $400, $500 a month. We're renting them now for about $1,000 a month. So now, I told you that we bought the property for $330,000 back in 2020. We just spoke to our real estate agent this week. He says he can put this property in the market for $1.1 million. Powerful. Let's look, what about my passive investments? So the one down here, the one on the lower left in Atlanta, we put in an allocation for it. It has been giving us rent, mailbox money for the past year now, reliably on a monthly basis. In the end, it's supposed to give us about 8% annual cash on cash, and then it's supposed to more than double our return, double our total return in the 3 to 5 years that our money is in it. So we should get 200% in 3 to 5 years. The one in the middle, it's a development deal. We put that money in, we invested in that passively. And we put it in the end of 2020, end of 2020. And we should be, basically get a 60% return. Now this wasn't, this was a development deal where they're building townhomes and they're selling all the townhomes. And then basically once they sell all the townhomes, the profits on that are going to go back to the passive investors. We should be getting a 60% return in 2 years. So if you put $100,000, we should be getting $160,000 back as a passive investor without us doing anything. The property on the right in Houston, that's, we got our second quarterly payment. Again, it's roughly about 8 to 10% cash on cash. We should be doubling our money within 3 to 5 years. We've also become general partners. So we're the sponsors. We're part of the originating team and the operating team for some of these apartment complexes. So a couple of weeks ago, we closed on an 130 unit apartment complex in Atlanta. That's what we're seeing pictured on the left. That's part of a fund that owns a 200 unit including that one, plus a 200 unit apartment complex in San Antonio and a 200 unit luxury apartment complex in Houston. And so we're now on the general partner side of the deal. So we're part of the active management team of this. On the right, we close on a property, a 220 unit property in Houston near the Johnson Space Center. And again, I think a number of you that are on this call are passive investors. And, right now, we're in the process of doing renovations and raising rents and decreasing delinquencies and, increasing the vacancy so that we can pump up the returns and increase the appreciation. And we're also doing our renovations for that so that we can get those 8 to 10% cash on cash and that 200% total return for our passive investors. So 3 years ago, I knew nothing about real estate. This is what we've accomplished in 3 years. You can do this too. I still love doing what I do, but I feel much better knowing now that I get to do it because I want to, not because I have to. So these are pictures of our residents. The picture on the top right was actually in the middle of the pandemic. So I think we kind of violated pandemic rules by taking off our masks, but we kind of wanted to show that we were united and, had resolve during that difficult time being in the hospital. Lower left is our, our recent groups and some of our recent graduates. We just kind of end of the year bash at one of the local distilleries. So I still love doing what I do. I have much more confidence and comfort doing it now that we've got multiple streams of income and wealth for us, because we can now spend more time. We just was this past summer up in Canada where my kids got to spend time with all of their cousins back home in Canada. I know that we will have more time to be able to do these things or to do neat things like go down to Napa, which is what we have pictured on the lower right. How do you get started? So if you haven't, these are good starters for you. For big mindset, big conceptual ideas, talking about the cash flow quadrant, becoming an owner versus an employee. Read Rich Dad, Poor Dad. I read it when I was in dental school and I thought, I don't need this. I'm a dentist. I'm going to earn several $100,000. I'm going to do that for 30 years. I'll be fine. All of a sudden I kind of came across it again 20 years later. The Ultimate Beginner's Guide to How to Invest in Real Estate by Brandon Turner. That's a great starter book. If you don't have much money to begin with, the book on investing in real estate with no and low money down, also by Brandon Turner. If you are looking to get started in investing passively into syndications, this book here by James Kandasamy, Passive Investing in Commercial Real Estate, Insider Secrets, is a great resource on how do you evaluate syndication deals. And I'm just going to leave this QR code here for a little bit because this actually, I kind of put together on our website a little primer on getting started in investing in real estate, both just the terminology, the basic terminology, a little bit about our story, a little bit about real estate versus stocks and bonds, and then a little bit about how do you get started in passive investing. So, take a moment, take a screenshot of this, or put your phone up to the screen, and it'll take you straight to my website where I put together all of these resources for you. In summary, know the value of your time. Being wealthy does not involve trading your time for money, even though you're in a job or in a career that pays you a lot for the time. Don't get golden handcuffed, stuck in the losing loop. Traditional financial planning alone will not cut it. $1 million, $2 million, $3 million, $4 million, 25, 30 years from now, it's not going to be enough. Real estate is a proven asset class to invest in amongst others. It's not the only one that I'm invested in, but it's one that I think is got a track record and has made a number of people wealthy, and it's preserved a lot of wealth for individuals. There are many ways to invest in real estate, and you don't need a lot of money to get started. Just get started. Get educated, connect with mentors and partners, and take action. I know a lot of individuals that have they've read all the books, they've listened to all the podcasts, they've gone to all the seminars, and it's 2 years, 3 years, 4 years from now, and they just haven't done anything. The best time to start is now, as long as you know how to do it, as long as it's how you can do it wisely, and you've got partners and mentors to work with. So without further ado, the last thing is, I love talking about this. I love talking about all things finance. Shoot me an email, take a screenshot of this QR code. You're able to, you can set up a time just to chat with me. If it's whatever it is, just any of these concepts. If you're looking at your first property, or you're looking at investing in an opportunity there, I just love talking with folks, guiding and mentoring you all about this. I hope that you've gotten some value out of this. I thank you all for spending your evening with me tonight. I'm going to stop share, and I'm going to turn on my camera, and I'm going to take your questions. So one of the first questions was, what's the difference from Dr. Vatcher? What's the difference between the return on investment and the cash on cash? So, the example that I had was, let's say you put $100,000 for 5 years, and that $100,000 has become $200,000. That's your return on investment. So, that includes the income that you earned from the property plus the appreciation, the value of it. So that's your return on investment. Cash on cash is actually the income that you get on an annual basis based on the amount of money that you put in. So using the example of the $200,000 property that we put $70,000, you put $50,000 down and you put $20,000 in renovations. You have put $70,000 down of your own money in that investment. Let's say that investment generates $7,000 a year. That's a 10% return on your investment. That's cash on cash. So cash on cash is income. Return on investment is your total returns, whether it's income plus your equity via appreciation or profits on sale. So that's a great question. And again, I kind of go over some of those things on that, in those primers, in those books, and then also that resource that's there. So great question. Any other questions, or even any other discussions or any other ideas?
I guess I can ask one. I'm just curious. What's your, I guess, going past the past 3 years, what is like one mistake you think that you hope nobody makes that kind of started your journey to be kind of a little bit harder than it should have been, I guess? What's the biggest learn, I guess?
Yep.
That we would expect in our first year, I guess.
So biggest learn, let's talk about if you're an active investor. So, because that's the one that comes to mind for me. So that property, the Florida property, this one was an off-market deal, and it was by a wholesaler, and we knew that there was going to be a bidding war. And so we didn't do as much of a due diligence as we should have, as we normally would. And we kind of took a chance, and so due diligence meaning you inspect the property, and, you look at all the, look at all of the things that you have to fix potentially, and kind of get an estimation as to what that's going to cost you. So getting caught up in all of that, we relied on, kind of a superficial walkthrough by our team, our real estate agent, and they had a contractor with them. And so our renovation budget for it was less than half of what we thought it wound up being. So that was our biggest mistake. So then when it came time to actually renovate the property, it was more than double what we originally thought it was going to be. I think I said 150,000. We originally thought it was going to be about 70,000 to renovate it. So that was the biggest mistake that we made. But then part of it was because they were, it was an off-market deal with a wholesaler, and we knew that there was going to be a bidding war, and we took a chance because we knew what properties of that caliber were going for in the market, And we thought that 330,000 was going to be a good deal. So that was the biggest mistake. It was painful as we were going through it, but as you can see, you know, the equity that we built on it and the cash flow that we were able to. So it basically hurt our cash on cash because, you know, our initial upfront money was significantly higher. But, you know, nevertheless, you know, it still is turning out to be a good investment.
All right. Thank you. Great talk.
Anything else? Going once, going twice. Any resources for how to manage a house hacked duplex, triplex, quadplex? I think the book on buying money with no money down kind of covers that. So yeah, so kind of, yeah. So I think that's probably a good resource to start with for house hacking. Thank you, Marcus, and I think you joined us from Georgia, right? So thanks for joining us. So I think we got Georgia, we got Michigan, we got Charlotte represented. Where else do we have? Former residents, out of state, in state. So going once, going twice. Again, please free to reach out to me. I hope you got some value out of this. I will get the recording out to all of you. Otherwise, thanks for, you know, I think you've taken a great first step learning, and please feel free to reach out to me with any questions. I would love to talk to you about this. Have a good night.